Hey traders, this is Ron Haight and happy hump day. Hope you guys are having a great day today. As always, everything in this presentation is for educational purposes only. All right, we're going to kick off here with a daily chart of the S&P 500 ETF, the spiders. This is using Thinkorswim. Today, it's around 4:20 p.m. Eastern. The S&P closed near the highs of the day. At one point, it looked like we might close near the lows of the day, and then comes towards the end of the day rally. So from the video on Sunday till the video today, we'll call it the midweek update, nothing has changed. Bulls are still in control. If I zoom in, the red line is the 20-day exponential moving average, and the orange is the big one we're going to pay attention to. We get below that one, and that is the red flag. We got problems. So we just bounced along the 20-day the last couple days, and today we're sitting up here. So the daily chart here is bullish. If we take a look at the DIA, the Dow, up 0.87%. A little off the highs, but still we're pushing higher. We hit the 50-day in orange here, that institutional moving average. We got sort of close to it here, and now we're just pushing up. We are into the gap, and we've today effectively filled that gap. This is still bullish on the daily chart. Take a look at the Qs. Check these guys out. So here's Wednesday, and there's Tuesday, and here was Monday. I was thinking about doing a video on Monday night, which is one day after the weekend video, and I was thinking, let's see if we get follow through, because I don't really want to put out a video that just says, hey, bearish engulfing, heads up. And candlestick terminology, we always want that second day, that confirmation, and we never got it. So this was bearish engulfing. Let's zoom in. Here was the previous day's candle. Here was Monday. We gapped up here, closed down here. We engulfed the previous body of that candle. This is big time bearish as a one-day pattern. We need the second day. So this is one day completing that pattern. I guess we could say it's a two-day pattern, but we need that confirmation. We need one more big down day, and because the red line has been really acting as support for so long, I want to see a break of that. We closed below there after bearish engulfing, and there would have been a video, which would have been Tuesday, and it would have been heads up. This might be the correction. And what happened? We trended down to the 20-day, finished back up at the highs of the day yesterday, and today we had a little bit of a dip, and then we closed back at the highs of the day practically. So there's still this appetite for stocks. People are not getting scared, traders are not getting scared, and we have really 2 strong days of volume after that one strong day of selling. So as of right now, the bearish engulfing is still there, but it almost keeps getting weakened as each day goes by. Now, if we do not set a new high, and we roll over and break the 20-day, then this could still play out as a topping type pattern. So I'll just keep an eye on it. Bottom line though, this is still bullish on the daily chart. Is it a yellow flag? I don't know, maybe a light yellow flag as it stands now. Now check out IWM, Indigo Whiskey Mike. This is the Russell 2000 ETF. Today, 3.67% pop on a pickup in volume and at the highs of the day. The 50-day, we sort of got near it back in June, near it the end of June, and then we flat out hit it on the 9th, got close to it the 10th, the 13th, 14th was just yesterday, and today we just launched ourselves. The 50-day on the Russell here is huge. We get below there, I think that's a massive big deal because look, support, 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 support. Every time we hit it, there's been a buy point. Now it's becoming a launch point. We're spreading the Bollinger Bands in green. This is all bullish action. So these guys are bullish too. Maybe they're going to start playing catch up. We shall see. Now there's earnings to watch tomorrow. We got Domino's Pizza. Just to give you some context, let's go back and look at a one-year chart. Here was the February window, which is usually seasonally bullish. Domino's is one of those stocks that has, depending on what week we look at, throughout its history, a perfect track record. It was incredible. So this earnings pop was right on the money, right on schedule, worked out great. Then we have the COVID pullback, fills the gap, and now we're sitting up here at new highs. The company has earnings. The question, I think, is going to be, are people sick of pizza, or the fact that you can't go out and dine as much as you wanted? Are they going to start saying, you know what, we want Chick-fil-A, we want something else? The Chick-fil-A around here is crazy. It's wrapping around. It's out on the highway. It's nuts. But is there a change? Are they seeing a change? If there is, this stock could gap down in a big way. If not, maybe we get brand new highs. Who knows how big this move could be if people are continue to eat out at DPZ. Now, there was a question I received. What would be an example, an educational example in a paper trading account of what an at-the-money put would look like on something like Domino's? And it could be Caterpillar, Domino's, Google, Apple. It doesn't matter who it is. So what I'm going to do here is we'll click on the trade, type in DPZ, And usually 45 to 60 days is ample. Now, August happens to have 37, so it's a little short. You usually don't want to hold long options inside their final 30 days of expiration due to the time decay issue, theta decay. It's a real killer. But if we're only going to hold it for a couple days, it could work. A little more time is better. I prefer monthly. So if I went out to September with the stock at 413, what would be an example of an at the money put? It would be strike 410. Now, normally, this O is the open interest column. I want at least 200 open contracts. That's a mean number. That's not a scientific number. And I typically never want to be more than 10% of the open interest. I want to be a very small player. We don't have 200 open contracts. Could I still pull the trigger? Of course I could. Or I could go in here to August. There's not a lot of contracts here either because Domino's is such an expensive stock. It's not. I know Apple's expensive, but the daily volume here is dramatically different. DPZ's stock volume, for example, 1.1 million shares. If I show you something like Apple, it's 37 million shares. And then if you go to an at the money put, look, there's 600 contracts. There's 2,000, 4,000, 5,000. There's just a lot more open interest when you compare Apple to Domino's. So in this situation, since both open interest is pretty small, it doesn't really matter. I would look at the bid-ask spreads right now. It's a $4 bid-ask spread, which is egregious. That's awful. Should be hopefully on something like this, 50 cents or $1 is max. I prefer 20 cents, but it's not going to be realistic in this use case. Here it's $3. Maybe something here I would come in and maybe try to get the mid price, see if that could happen. At least there was 32 more contracts that were traded today. That's going to raise it a little bit. So that would be an example of an at the money put. And then what I would do is if the stock gaps down, I hold it till the stock starts to form a bottom. If the stock were to gap up, let's say tomorrow and start running higher, I could simply just sell the long put back tomorrow, close it, sell to close, and just exit that insurance position. When the stock goes up a lot, the puts lose a lot of value. But when the stock does drop, those puts can be lifesavers. Now, another stock that has earnings tomorrow is Netflix. Is everyone still stuck at home? Are they out? Are they canceling their trials? Are they canceling their subscriptions because they can go back out? We just have to wait and see to see how this plays out. I mean, we were back here at 250 in September. Then we were back at 300, upper 290s here in March. And then we're sitting all of a sudden at 500. Now, there was almost bearish engulfing, not quite, but there's been no real follow through at this point. With earnings, we could blow through the 20-day in red, the 50-day in orange, which is the big institutional moving average. We could go way down here. Who knows where we could go? Or we go to new highs. So if I'm still trading Netflix, especially this, we have no idea what could happen. Are they making money hand over fist? Are they losing subscribers? You get the idea. I would still want that protective option. Something like that on Netflix. Now, this is 9 million shares. Again, way more than DPZ. Let's come in here. If we go to September, what are we looking at? 200 contracts. Here it's $2 bid-ask spread, 220. That would be an example of an at-the-money put on Netflix. And somebody else asked me one time, what if your cost basis, for a hypothetical example, was $100 or $200 or $300, and there's so much profit in these shares? Why would there even be a need or a necessity for that protection? The answer is, I'd want to protect my profits personally. So yeah, I would even consider buying a protective put for this situation just so I wouldn't be giving all that back just in case the stock had a bad, I shouldn't say a bad report. It's more, what is the reaction to that report? All right, other stocks that are I'm going to talk about here are Delta. Some of these stocks that I'm going to list next, Delta, Cheesecake, Darden, MGM, they're starting to find some love where they really haven't gotten that much love. They had a big rip here. If we zoom in, they had a big rip here. They then pulled back, and all of a sudden today we get an explosion. This is post-earnings. Volume picks up. Well, their target will be back up here to these highs. That's a considerable move on something like Delta. Take Cheesecake Factory. They just got back above both moving averages. Their volume just picked up. Their target is back up there at the previous highs. You're talking $6, what, almost 25, 30%. Darden, like for Olive Garden, for example, all of a sudden a pop. Volume picks up. It's sort of like, is there a rotation going on where stocks that have now been the high flyers, they're now starting to exit? Take something like, I don't know, I think I was looking, yeah, Shopify coming down off the highs, or Wayfair, maybe not so much. Or how about Etsy coming down off the highs? Are they now saying, you know what, let's sell these things that we've 3, 4, 5, 10x'd on, and now they're going to go find the ones that maybe aren't, that have not been performing as well, and now we're seeing a pop. So if I was going to use Cheesecake Factory as an example, I would go right back to this most recent low and say, hey, we get below there, that's the stop out. If I go back to Delta, Same thing, I'd go back to yesterday's low. We closed below there, I would then stop out of this position. Just, you can practice this in a paper trading portfolio because, there's no risk and it's a great place to learn. Darden, let's go back here. Same thing, we get below the most recent low. Now you could say, well, what if we go back here? All right, tomato, tomato, we're splitting hairs. It's got to be something. I wouldn't cut it so close that we use one of these moving averages because there is a gap here. It could easily come back down and fill the gap and then run. You break out, you fill, and then you go. So I would come back again, use that most recent low. And then MGM, the fourth one, these guys were up 12+% today. Look at the volume on the updates. Big volume coming in. Their target now is going to be up there at 23. I mean, geez, that's almost, 40% higher. I had a question on Tesla and NKLA. I'm even going to bring it forward here. So here's Tesla. This was pure insanity on Monday, almost $1,800. Now, some of these stocks are running, and maybe this is why the NASDAQ is running. I believe it's Robinhood sells fractional shares now. Schwab, I saw a commercial on TV. They're doing fractional shares. Maybe this is the shift in sort of trading that some of these stocks like a Tesla, a Google, and Amazon that would be so expensive for a retail trader, which is generally us. But let's say a retail trader with a smaller amount of money per se, they can't buy it. If they have $500, $1,000, they still can't buy a share of Tesla. But if they're doing fractional shares, they sure can. Maybe this is adding to some of that ridiculous momentum that these stocks, which are certainly not fundamentally based, that's just pushing them higher. The sentiment's gotten crazy. Will earnings be the next decider? Don't know. It looks like Tesla has earnings here, 7/22, so it's about a week away. I would still want protected puts for something like Tesla. I would just be too concerned to not. Now, the flip side of that is, if this was a smaller amount of money for me and I didn't care if I lost it all, well, that's a different story. But generally, I don't like losing money. I prefer to protect it where possible. So just practice on paper. Bottom line, Tesla is still bullish here on the daily chart. It is looking a little toppy, but it's above 20, it's above 50. Maybe the earnings report will get some clarity for the stock's future. Here's NKLA. Remember I said this one, when it got really crazy, then it was consolidating, it was still a bull flag. I said, watch the 20. We break that 20. The question is, where would we go next? And I said to you guys, right to the 50. That's all we really got to work with. And look what happened. By the time that stock closed, it was at 57. And then all of a sudden, 2 days later, the close was 40. That's a huge drop. And it hit the target, and now we bounced, but we can't get above the orange line. Excuse me, we can't get above the red line. We break the orange, then you start coming all the way back down here for targets. That would be pretty considerable. So just keep an eye on this one. But it actually played out just as if I would teach it. Now here is Ford. Look at this. There's the possibility this could be a cup handle, attempted breakout maybe, depending how you want to do it. It's not absolutely perfect, but we get the rip. This stock goes from 5 something to 7. That's huge for Ford. Comes back, tests the 50-day, open below it, comes right back up, and now we're launching. So the target's going to be up there 7.5, or even the high of that day, which is 774. And then there's 2 questions, one on ROKU, one on Boyd Gaming. Here is ROKU, ROKU. Let me go back here and just show you Max on a weekly. This is a weekly chart. The previous weekly high was back in September. That's pretty much the main target. But as we've gotten up to these previous highs, which occurred back in November, right around the holidays, Thanksgiving, coming into Christmas and Hanukkah, we're there. So this is going to be overhead supply. So it's not surprising to see the stock finishing off the highs so far. That's just natural. If I go to, and if you're wondering what that means, the folks that bought over here and here, they've been wrong for about a year. So now they can get their money back and say, whew, we got the money, let's sell, and we move on. What that also means is once this overhead supply is taken out, blue sky territory is truly the limit. Who knows where this thing can go because there's no more sellers left up there. Let's go to a daily chart, 6-month daily. That's not very good. Let's do 1 year daily. And there you can start to see it. Look at that. November 26th, we get up there, smacked right back down. We were smacked down about 10 points. And then you're looking over here at that bear. Ooh, that was pretty bearish engulfing, wasn't it? Bearish engulfing, dropped sideways, and the bottom falls out in September. So it looks like bearish engulfing here might work if we were to get one again. But you see the previous highs. And then Boyd, BYD. The casinos really, boy, to use bad English, they are screwed. I think they're in trouble here. But whether that translates into stock price or not, I don't know. Boyd was up 18%. I mean, they take half the capacity out of the casinos. People get laid off. They still got to pay their rent at the old price. So how are they going to be able to handle this? Tell you what, based on today, it looks like they're going to handle it just fine. 18.5% rise on Boyd, huge volume. Gap up, close the highs. We've taken out a previous swing high. Target's up here at 25, and then it's up here. So whether or not they're trading on fundamentals, I would think these casinos have massive headwinds even now because this perpetuation of, of the, I don't want to go down that rabbit hole, but it's as if you, depending what news station you listen to, you're not even supposed to go outside, right? Well, if that happens, these are going to collapse, the jobs are going to be lost, etc. And the casinos in our area, from what I'm hearing, you can make appointments, half capacity. They still have the rent. The rent payments didn't change, just like for the average consumer. As I've said in previous videos, 2/3 of our economy is service oriented. They still got to pay the rent. So if the rents aren't being paid, then the landlords can't pay the banks, and that becomes this domino effect, which is going to lead to less discretionary spending. So far, though, these stocks are holding up. The trend's your friend, as I like to say, and I would just encourage practicing and using stops. And if I wanted to trade Boyd long, just like I used in some of those other examples like Delta, Cheesecake, and Darden, I would just go back to the previous low and say, hey, if we get below there, it's a dead duck trade, a trade idea. Otherwise, target and see if it actually happens. So longer video than I thought. We'll call it the midweek update video. The next video will be Sunday unless something crazy happens tomorrow. So wish you guys all the best and enjoy summer. See you in the next video.